Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today I'm going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive right in, take a look, see what's going on today. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com, where I dive deeper into all these topics, subjects, sectors, looking for investment opportunities, sharing those opportunities with everyone in the community. I do that through midweek updates and question and answer sessions during the weekend, either a Saturday or Sunday one, depending on which weekend it is. If you're interested in signing up, special is the coupon code that is active right now. You get 50% off the first month only on the monthly membership, and a larger discount on the yearly membership. All right, I got this posted up here: Chevron, Conoco, and Exxon Mobil charts. I just like to look at all different charts. I don't discriminate if something's big, small, what sectors they're in. I kind of just peek at everything. And then I come up with an idea of what I think is going on. Now, when looking at Chevron, Chevron, in my opinion, has broken out of the consolidation. The 1, 2, 3 hump consolidation, we've broken out of that, and we've done a consolidation on top of the breakout. It's something very similar. You can see the circle there, the orange circle, very similar to the orange circle here before in 1989. We had another big consolidation. It started off the bottom of 74, 75, came all the way up, consolidated here in a big three hump consolidation in the 80s, broke out, did a retest in late 80s, probably 87 would be my guess. And then we went from 87 into a gigantic bull market all the way up to 2008. We are now starting a gigantic bull market is on its way. And we're right at the beginning of this bull market because I think that circle is where we're at fractal wise. We've got the three hump consolidation just like the early 80s, which was pretty long. We went from 2008 to 2021 or 2 on the breakout. So that was a gigantic consolidation, another gigantic consolidation. And then I think we're going to break out of this consolidation here to the upside for a very long, very big oil bull market. Very similar to 87 to 2008. 87 to 2008. That's a 30-year bull market. Now, I know some people have asked me, Andy, what's the exit plan here? If I think something like this could occur here, and I really honestly do, I think something big is coming. I think we're going to see interest rates go up into a bull market, so higher yields. And I think we're going to see oil be a leader of maybe not a leader. It will benefit from the market conditions that I think will come for a long time. So will silver, so will gold, so will a lot of other commodities. I think financial assets are toast, and we're coming towards the end of that bull market, and we're going into a ridiculously big commodity bull market. And this pattern here is showing that. We're right at the beginning. Here's another one, ConocoPhillips. And I like to get Confluence. Confluence is a bunch of information that agrees with my opinion. So that circle there is the same as the circle roughly where ConocoPhillips is. Now, ConocoPhillips did a little bit different move than Chevron did. Chevron had a big move up in a sharp pullback in like 87 or 88 or something like that. Conoco did a very similar move, but pulled back in 91, 92. So very similar. And it broke out of the three hump consolidation in the 80s. So it's not about these matching perfectly. It's about consolidating roughly the same time frames, breaking out of those consolidations, creating similar fractals of today versus what happened in the 80s, 90s here. And then the big move up. This was wave one, wave two, wave one, wave two. Wave three is this big long one here. And then wave five is this one that went from mid 2000, like 2002, 3, all the way to 2008. That was the fifth wave. Then we consolidated sideways and we've broken out of the consolidation and we're sitting on top of the pattern here. And here's ExxonMobil. ExxonMobil, it was a little bit stronger company. You can see in this consolidation back here, it was angled upward, probably doing share buybacks, probably one of the strongest companies historically. They generally angle upward during consolidations. Then in 83, we had a nice big move higher all the way on up to 2008. Then we had a big consolidation sideways with a blow off slingshot move in 2018, 19, 20. This little slingshot that blew all the way back up. And we've broken out of that consolidation to the upside, and we've been consolidating on top of support. They all say the same thing. Conoco, Chevron, and ExxonMobil. They all say the same thing. Now, somebody says, let's go and look at the thing here. Someone said, oops, let me hit this up here. They said, compare it to the SPY. Those charts look bad. So, okay, let's compare it to the SPX. That's what S&P 500, SPY, SPX, the same thing. So this is the way that I view it. And it's not going to view as someone else. They're going to say, oh, this looks bad. It's been underperforming. Guys, you need to buy it when it's cheap. You don't buy stuff when it's expensive. The SPX is expensive in relationship to Chevron. I just chose Chevron. So let's throw this down here, right? So I'm gonna do this. I'm gonna kind of just I need to make it a little bit larger here. So just hold on, and then I'm gonna kind of zoom it out. So there's your kind of cycle, right? I don't know if it's perfect. I didn't spend a bunch of time doing this, so I've just threw this up. There's your cycle. What this means, and I know it's not perfect. I think we have to stretch it out a little bit more here. Okay, so something on the lines of it's something on the lines of that, all right? So something on the lines of that. We're close. When you buy this, you want to buy SPX here, SPX here. You want to buy Chevron or oil companies here, here, and here. And if you look, we're actually at doing a double bottom here. This is a big double bottom, and we're right at what would be a spot that's lower than both bull markets, which means that the SPX is overextended against energy. So the way that you read this, so he said, oh, the ratio looks bad for this particular deal here. No, this is what looks good. You want to buy it when it's down here, here, and here. That's what makes it cheap. If you bought it in 2020, you would have killed it, so to speak. Now, I wouldn't have bought Chevron. I would have bought some other companies. So Chevron, when you look at the let's just go back here. We'll do CVX. So Chevron, the buy point in 2020 was right here. That was the cheap ratio. The other cheap ratio was probably like here. Well, we can look at it. CVX divided by SPX. The other ones were 2000. Yeah, that would have been perfect time. And then another one was in 69.70. So if we would have purchased those ratios and those ratios only, let's go log. So 69.70 would have been right here. We would have bought it right at the bottom there. The other one was here, and then the other one was the circle there. We would have nabbed every single bottom there, given the ratio. That would have been a purchase for Chevron, and a purchase for Chevron. And you would have done incredibly well. And we got another buy point, I guess, here recently too. The more neatly you fit into society, the less free you actually are. You know, when you invest, Everything we do is about fitting in when we grow up. Think about all the things that you wanted to do and wear and be when you were a kid, how you just wanted to fit in. And then we're over here trying to invest and do the exact opposite. We want to do the exact opposite of everyone else. We want to not fit in. And that is, I think, the most difficult part for most people. I would say most people, just from my experience of talking to a lot of people about investing, is they seek other people's opinions and they want them to match. And I don't know why they do that. It's like they want someone else to match maybe my opinion, or they want an opinion to match theirs, or they generate their opinion off of other people's opinion. That's more of a herd or sheep mentality, is to follow others and then do what others do to the T, um, than making up your own decisions. And it's difficult. It's difficult because all our lives is like that. I was like that. I was like that for a very long time. When I grew up, I just wanted to fit in. I mean, I wanted to be thought of as cool and all that stuff when I was a little kid. It's the way it is. But you just want to fit in. It's interesting. And then as I grew older, I kind of grew out of the mold, so to speak. And I'd say that started in my 20s. 20s is when I really went off the rails, to so to speak. And it wasn't in a bad way. It was just in a way that um, society had like zero influence on me after that point. And then things faded away as I realized that things aren't based off merit. They're not based off of value that you bring to the table necessarily at work. So I was like, I don't need to try as hard. Never forget this time it's different. U.S. stock valuations hit new all-time highs. Remember that Chevron to S&P 500 ratio that we did at the beginning here. Chevron was also cheap just past 65. So it was 69 when it was cheap. 29 was a market peak in the SPX, market peak in the late 60s, market peak in 99. It was the bottom for energy stocks. And look where we're at right now. It's in the same exact spot. And this is a brand new high as of August 25. What does that mean? Why does it matter? Well, it means that it's dangerous. US stock valuations hit new all-time highs, and it's dangerous to be in that area. So I'm not in that area. You know what else was good during these time frames? Energy. Maybe not 1929. That was a big deflationary bust. But 65, 99, and where we are today, it's going to light it up going forward. And you have to get bullish when everyone else is bearish. That's the time to be bullish. VO says, I feel like 5 million is still the number for anyone. If you think it's higher, I'm sorry for you. And he goes through, he says, put 100K in a checking account, put 900K in a money market fund, a money market account, or a 4 or 5% bond ETF. Put 2 million in the S&P 500 equal weight ETF. I wouldn't do that, but buy a nice piece of property for 1 million and then spend the remaining 1 million to build a custom home. GC the project yourself, get it appraised for 2.5 million, then mortgage the entire property for 2 million, leaving 500,000 in equity. Put that on locked, 2 million in the S&P 500 or maybe QQQ ETF. You have a dream property, you have cash in the bank, you have an average expected 300,000-400,000 passive income year one after paying the mortgage. You can mess around with business ideas, have hobbies, enjoy family, travel, and delete your LinkedIn. Yeah, here's the problem though. The problem here is, and this is just for me, is 5 million enough? I mean, if you would have asked me 10 years ago, Andy, is 5 million enough? I'd say, oh, for sure. But I would have also said, is 2 million enough 10 years ago? You said, yeah, 2 million's enough. But ask yourself today, is 2 million enough? And it's like, well, yeah, yeah, maybe not. If 5 million's enough, then maybe 2 million might not be enough. 10 years from now, 5 million might not be enough. And I like having wiggle room. So 5 million today might not be enough in the future. Is it enough wiggle room for unknown, events in the market? Now, if this guy put an S&P 500 equal weighted ETF, what if that gets destroyed or doesn't go anywhere for 15 years? And the way that I would do it, my allocation would be way different than what he has here. If I had 5 million bucks, I would put stuff more so into the undervalued assets in commodities and energy. Um, I put 900K in energy stocks that pay on average maybe 10 to 15% dividend yields. And I would just sit in those. I would do precious metals as my bonds. So rather than bonds, I'd rather own precious metals. And I would set this up completely different than what he has here. But I do question the 5 million number. Is that enough? And I would say if you own everything, yes, it's probably definitely enough. If you're still paying things off, if you have kids and there's other things and you're young, maybe, maybe not. I don't know. That number might be a little bit different. Tough to say. Kesh Gupta says, Bezos, somebody needs to make a list where they rank people by how much wealth they've created for other people. Instead of the Forbes list where it ranks you by your own wealth, Amazon's market cap is 2.3 trillion today. I own about 200 billion-ish of it. So if you take the 2.3 trillion and subtract out the piece I kept for myself, then I've created something like 2.1 trillion of wealth for other people. That should put me pretty high on some kind of list. And that's a better list. How much wealth have you created for other people? That is a pretty good thing to think about. I was just thinking about some of the net worths of government officials and how much wealth have they destroyed of other people to confiscate that wealth that they took. We should create that list. That would be a good list. Um, yeah. So JC Peretz, for the first time in 2025, the world's most important stock market index just finished the day at record highs. Is this a sign of a top or evidence that this bull market is just getting started? I don't know. It's a good question. I don't like the valuations. That's what keeps me from going whole hog in any of these, the S&P 500, the NASDAQ. I just can't do it, guys. Your risk is too high. So although it could go up and although we have breakouts on a nominal front, I don't know if they're going to gain in real terms against energy and other asset classes. I know that the government needs to get these all up nominally. And what that does is it increases taxes. They need to increase taxes. So what they're going to do is they're going to dive bomb the dollar. So I don't know. We'll have to wait and see if this is something of a new breakout or if it's a false breakout and it reverses. I'm not exactly sure. We'll wait and see. I'll keep my mind open. But it doesn't mean that if this is a fresh breakout, that is where I want to be. Because if I don't like the valuation, I don't want to be there. It's not going to give me the conviction to hold on. I'm gonna jump at the first second I'm going to try to get out. Warren Buffett says it's better to hang out with people better than you, pick out associates whose behavior is better than yours, and you'll drift in that direction. What's difficult for me is it's better to hang out with people better than you. You mean like if I'm playing hockey, it's better to hang out with people who are better than me at playing hockey, or baseball, or investing? I think that's what he means. Um, Pick out associates whose behavior is better than yours and you'll drift in that direction. I'm sure that's probably pretty true. Morgan says, changing your mind is hard because it's an admission that the certainty you once thought you held was an illusion. Now, I want to hang on this one here for a second. Changing your mind is hard because it's an admission that the certainty you once thought you held was an illusion. I think it depends. It depends because there are certain things in this world that you can be certain, maybe not certain, but you have a high conviction, but you don't know the timing of it. And if the timing doesn't come to pass in a fictitious time frame that humans make up, it doesn't mean you're wrong. So it's not that you've got this certainty. So, for instance, I've been bullish for bullish commodities and bullish energy specifically since 2020. And we've had a consolidation here for 2022 into 2025 on the physical price. The price has been high, and some of the oil equities have done incredible things. They've continued to go higher depending on the equity that you're looking at. And a lot have pulled back in energy service and other sectors. Now, just because I'm bullish on it on the long term doesn't make me wrong. And I wouldn't change my mindset until we get to an expensive state. So I think what's important here is to know when you need to flip your mind. And changing your mind is hard because it's an admission. That's true, what he's saying, but it's difficult to know when it's okay to change your mind. So other people, they're so short-term oriented. And the advantages that I'm taking from the short-term oriented people and buying equities and buying oil and energy related stocks because of the long-term secular bull market that we've entered in 2020. That's what I'm using as my advantage. It's the fact that people are changing their mind, admitting that they're wrong in the short term, and I'm coming in and buying shares from them because I have a different time frame. So I'm basically extracting value from short-term market participants, stealing their shares at cheap prices because of a time frame difference. So it's not about changing your mind because it's an admission that the certainty you once thought was held as was an illusion. I don't know if that's, see, this is where you have to understand the different time frames and the big picture view. And you need to take and extract. So basically what you're doing, and Buffett's got a quote on this, it's um, the money changes hands from the impatient to the patient. And that's taking different time frames and viewing the world in different time frames. So people are going to say, oh, you're wrong. And they use like 6 months of data because the price pulled back. And it's like, look, dude, or he or she, you're on a different time frame than me. Completely different time frames. And people are talking over each other on different time frames. I'm looking at this like, oh my God, we have a bottom in commodities, which every single one of these was a bottom in commodities. Then we've got these big breakouts and all these different charts. Do you know how few of people are doing what I'm doing? Are looking at all these charts, are looking at all this data and compiling it off the top of my head. And then keeping it all in the back saying, okay, this is going to come all the way back down. When it comes all the way back down like 1980 was the best time to buy stocks. We will get there again, but that's going to take 20 or 30 years. I mean, this one here took 15 plus years because it came out in 82 and this was 65 for peak. And we're going to run into that again. In 29, you would have been screwed riding all the way. This is probably 1950. I mean, that's 20 years. So we've got 15 to 20-year pullbacks here from 99 all the way to, 2010. Yeah. They're 10, 15-year pullback. We'll get a 10 or 15-year pullback in stocks. is what I think is going to occur. Everyone else doesn't care. All they see is this breakout. That's all they see. Oh, we've got a breakout here. It's like, look, even if it goes up, I don't want to be there. This is not the spot to be. And I have to go back to the US stock valuations hit new all-time highs. Even this goes up a little bit. I don't want to be there. You're playing a 2 and a 4 in poker here. And they're not in the same suit. Charlie Munger says, part of the reason I've been a little more successful than most people is I'm good at destroying my own best loved ideas. Emerging markets have everything lined up to outperform. I firmly believe in the cyclicality of markets, and this time won't be different. Historically, EMs had to run current account surpluses just to secure enough USD to pay for energy and commodities. Now they increasingly have the privilege of buying in their own currencies. That frees up capital for domestic investment since fewer USD are needed for imports. Louis Vincent Gove calls this the reverse carry trade. Totally agree. Now keep in mind, when this is cheap, 99, where we are today, and this was 65. Remember 65 up above? This is the opposite of the US stock market. So US stocks were expensive here, here, and here. And this is gonna roll all the way back up like these other big bull markets. So 65 would have been a heck of a buying opportunity in this area for emerging markets. And guess what? We're back there again. What do you think I'm buying? Emerging markets. Yep. Now some people will say, well, it hasn't moved up yet. Wrong time frame. Wrong time frame. You got to take a longer time frame. Now some people say, well, if you're 70 or 80 years old, what do you do here? Well, I would still buy the bottom, but I might buy, maybe it's emerging markets bonds. Emerging market bonds would probably be a good bet, perhaps, because if the currency exchange rates move, which I think they will, you could get a big return with the bond markets and currency exchange. But again, that's just one idea. I'd probably rather play precious metals. There's no counterparty risk there. That's what I would play myself, the PMs. Here's Ian. He says, we often let our, okay, yeah, I talked about that one last time. So that's where we're going to end it, guys. That's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Specials, coupon code. That's all I've got for today. So, well, guys, we'll see you next time. See ya.